prior to the recession, so prior to 2007. Longer term bonds, so the big concern was that this crisis especially in the short-term paper markets, lending markets, would feed into the rest of the economy. And so the concern was that was going to dampen borrowing in lots of other sectors. So not just from financial organizations, but also just corporations in general. And so you see here, comparing it to the 5-year Treasury rate, that started to come down again in 2007, dropped quite dramatically when investors seemed to flee to US government bonds in September and October of last year. At the same time, the spreads that corporations could borrow at, the interest rates they could borrow at, went up quite dramatically. Again, the good news is that went up, it's come back down considerably. If you look at just the raw interest rates you see here, you're talking about interest rates that are around 5–6% for these different bonds, where they were a couple of years ago. Okay, so on an absolute level, borrowing rates really aren't that high today. Again, that's the good news for going forward. If you look at spreads, the fact that government bonds interest rates have come down so dramatically, other ones have went up or stayed fairly flat, means that, again, corporate borrowers can borrow at rates that are, in this case, quite a bit higher than comparable government bonds. So in terms of raw interest rates, the rates aren't that high. In terms of spreads above treasuries, the spreads look fairly large. Okay, and so that's a little bit of bad news, but again, more where we were at the beginning of 2008, towards the beginning of the recession, not where we were in October of last year when the credit crisis really started hitting pretty dramatically. In terms of the stock market, so a lot of what I look at is stock markets. A lot of those concerns fed into the stock market. Again, you can see volatility. So these are absolute percentage daily changes in the S&P 500 on a 20-day rolling basis. So just how much is the S&P 500 bouncing around day to day. Volatility started going up in 2007. Again, huge dramatic increase September and October of last year, and that has come way down as well. So over the last couple of months, the volatility in the stock market is, again, about where you would have been towards the beginning of the recession, if not a little bit lower. So in terms of just raw stock market volatility, we've really seen a dramatic change in how quickly volatility has come down. This is a longer-term perspective on that same question of how volatile is the stock market. So what I showed before was just a little piece of this graph, just a longer-term perspective here. Said we saw a dramatic increase. Compared to the prior 5 or 10 years, that was very, very dramatic and unprecedented. Compared to the longer term, the volatility we saw starting last year was high, but not unprecedented. Certainly if you continue this back to the 30s, you would see lots of time periods when